I have a new appreciation for what's going on in these major cities. I think that all major cities are crumbling. And I don't mean to be alarmist or very dramatic about that. It's just that I spent a lot of time with entrepreneurs that are in Paris, and they struggle with the same things that the people in San Francisco do. And then I had a couple of conversations with some folks that are entrepreneurs in London, and they suffer from the same things. Lots of petty crime, lots of garbage, lots of vandalism, lots of drugs. And so no place is perfect, it turns out. Everybody is struggling from a lot of experimentation gone wrong in how these cities run. I would say that India has its own vagaries, so those issues are not the same. I've been to Singapore a couple times. My kids were just in Japan for spring break, so I saw a bunch of the pictures. Those cities look relatively the same. Very orderly, well-run, clean. But these Western cities are a bit chaotic.
You also had this referendum in California that essentially lowered a whole bunch of felonies to misdemeanors. If you steal less than $950, that's considered a misdemeanor now instead of a felony. So there's been a huge increase in crime because of that. Shoplifting just doesn't get prosecuted anymore. And misdemeanors don't get prosecuted anymore. We've had all these stores, DAs who don't want to prosecute misdemeanors.
When New York City was a chaotic mess in the 70s and 80s, it took two different mayors and it took almost a decade for that to get cleaned up. They hired a lot more policemen and they just really cleaned up all of these really bad areas. And then it had this knock-on effect. When I'm staying at a hotel in Paris, or when I was speaking to some of my friends who live in London, it's the same thing. It's like the amount of knife crime is so egregious, as an example, that they tell you, don't wear a watch, etc. I mean, I don't wear watches anymore when I go out. But what's crazy is they will tell you that you'll get stabbed over a phone, where it's like, you don't need to stab me for my iPhone. Here, just take the iPhone. So I was like, should I really feel scared here? That stuff in San Francisco, as far as I can tell, or any major city in the West, hasn't really been fixed because you haven't had a shift in leadership yet where they've really said, okay, we're going to double down on policemen and policing, and we're going to amp up the punishment. That hasn't happened yet.
CPI higher than expected for 3 straight months now. As we all know, the Fed did 11 rate hikes in 2022 and 23, and the intention was that we would see inflation come down to their target of 2% and they would start to lower rates. And obviously, we're not seeing that. Inflation is remaining hot. Things are getting more and more expensive. Housing is up 5.7% year over year. Transportation costs are up 10.7%. Car insurance is up 22.2% year over year. The expectation has been that the market will do rate cuts. Larry Summers came out and said, you have to take seriously the possibility that the next rate move will be upwards rather than downwards.
The market was expecting 3 rate cuts this year, which would have been really good news for Biden. And I think this latest inflation print was kind of a dagger to the heart of that expectation. And I think the Wall Street Journal put it best. It said here, Wednesday's report had been hotly anticipated because Fed leaders had been willing to play down stronger than anticipated inflation readings in January and February, as reflecting potential seasonal quirks. But a third straight month of above expectations inflation data erodes that story and could lead Fed officials to postpone anticipated rate cuts until July or later. So it's not just the fact that this inflation print was higher than expected. It was also higher than expected in January and February, but people were willing to kind of overlook that, saying, well, maybe it was just kind of a quirky reading. But now we've had 3 straight months. It's pretty clear that the narrative that we had going into this year, which was that inflation was on its way down, peaked at 9% as the official rate, I think, in 2022, and then it was going down every month through all of 2023. And I think the expectation going into 24 was it would keep going down and we get these rate cuts. Well, after 3 straight months of inflation being more persistent and stickier than people expected, I think that narrative is basically dead. I think the new narrative now is rates are going to be higher longer. And I think Larry Summers is reflecting that view. Larry's going further. He's not just saying that the current rates for longer, he's saying they might actually increase. And that's a risk. And I think there could be several other knock-on effects that we should talk about. One is for the consumer. This means that the cost of borrowing is going to be higher for longer. That makes it harder to buy a house. Mortgage payments are higher. That also means if there's fewer home sale transactions, that means the price of housing could come down. So there could be a correction in that market. Second, if you want to buy a car, your car payment's higher. And if you have loans, your personal interest is going to be higher. And this is why I think consumers feel like they're worse off than the economic data would otherwise reflect. And Larry Summers actually had a tweet storm about this about a month ago, where he calculated that if you included the cost of borrowing in inflation, that inflation was much higher than people thought, and that it actually peaked not at 9%, but at 18%. So Larry had an excellent tweet storm on that. And he said that the cost of borrowing, which used to be calculated in inflation, but is not anymore, was the reason why consumer sentiment about the economy was depressed. He said that that accounted for about 70% of it. So people should be feeling better off because GDP growth is good and unemployment is low, but they're not because inflation is so high. And if you include cost of borrowing, the inflation's even higher. So I think this is really bad news for Biden, but it's a story that's been going on now for 3 years. It's not just this one inflation print.
The Fed Open Market Committee in December stated that they expected 3 rate cuts this year. And I think the market in some cases were predicting as high as 4 or 5. Now we may not have any, and we may actually see a rate hike.
But I mean, I think Summers gave that maybe a 15 to 20% chance, which is, it's still not the most likely scenario, but it's possible.
Chamath,
and no one was counting on that in December.
Chamath, if you're a Fed governor, and obviously the Federal Reserve Board of Governors sets rates, they make these decisions. How influenced are they politically? How influenced are they by this election cycle? And, historically, this is meant to be a fairly independent board, but there's been a lot of consternation over the last few years that this board acts like almost a political apparatus, particularly in election years.
I think that you're asking the absolute right question. I think that the Fed has become increasingly politicized. And I do think that there are actions that foreign governments take to influence the election, but I do not think it's what most people think. When I say that, most people's ideas goes to like some darkroom conspiracy theory and misinformation. And I think that's a little bit naive. I think the more obvious way in which other governments can impact the US election is exactly how Sachs said, which is they know that if inflation ticks high, and interest rates are up and consumers are under pressure and meaningfully displeased with the economy, they'll vote out the sitting administration. And so what can other governments do? They can do what they're doing. So I love this explanation in pre-charts. This is a core driver of inflation, which is the price of energy. And what you see here is that since the beginning of the year, oil prices have gone up, which ultimately will translate into a higher cost of doing business, running your factory, keeping the lights on, keeping your home warm, getting from point A to point B. All of these things go up, which would ultimately get reflected in prices, which is what inflation is. And so that's a very bad trend. Obviously, we had a lot of really good stuff happen through the course of last year, but it's largely reversed itself. It's important to double click into this and figure out, well, who's driving this? Is it just a random act or is it a systemic set of decisions? And it turns out it's systemic. So if you go to the next chart, what this shows you is what the US has been doing. The United States has clearly created an incentive to flood the economy with oil, which the laws of supply and demand would say prices should go down. And by bringing prices further down, they would have further brought down inflation and they would have pulled forward these rate cuts that we had been expecting from the Fed. The problem is that the rest of the world actually said, no, hold on. And that's what you can see on the next chart. So for every time we were trying to increase production, all of these other countries have been cutting production. And this is the change in the OPEC plus crude production targets of 2024. For every barrel of oil the US would pump out of the ground, more than that 1 barrel of oil would get actually restricted by all of these countries on this list, which is just to show you that these countries have a very specific view about how they want that energy market. And that's just one market, but it's a key input into inflation and rates to work.
So you're saying that the OPEC has a price per barrel price target, and they're able to manipulate production to maintain that price target. So while the US is trying to lower the price per barrel, these other countries are able to have a stronger influence and balance out production.
When you make these cuts like this, prices will go up because OPEC plus is meaningfully bigger than just the United States on its own. The United States may amp up a few 100,000 barrels a day, but if OPEC cuts by a few million barrels a day, you see what you saw in that first chart, which is the price will go up. And that's largely why prices have gone up. I think why this happens is because when they see the United States trying to manage inflation and manage global rates, right? Because US rates are not just for the United States. They're the trendsetter for everything else. I think that in part, there's a decision that this rate philosophy, the economic philosophy, the political philosophy, if they wanted to support that, what they would do is actually also keep prices where they were or increase production.
Right.
But by reining in production, what you're essentially doing is voting against that entire apparatus, right? So OPEC and all of those countries, and those decisions are not made by an oil minister, let's be honest. They're made by the leaders of those countries, whose decision then gets reflected by the minister of petroleum or oil in all of these countries, is a vote against Biden and the United States government and the politicization potentially of the Fed. And then the last comment is just that when you look at the reverse repo rate, which is a fundamental measure of liquidity, what you also see is liquidity very quickly getting sucked out of the system, which is also generally a system health check that the Fed uses to make sure that the system is operating as required. So in totality, what I see is that there is a structural disillusionment with the current administration and where people can make decisions in their own best interests versus the collective interests of the United States and a broader framework that the US may represent are voting against it. And so this is why the idea of a persistent inflation rate is a lot more credible than it was 6 months ago. And I think it's just what Sachs says, which means that we're probably now on balance 50-50 between a hike and a cut. And I think if you don't see this thing change in the next 3 months, you're going to see 75-25 for a hike of at least 25 basis points. And I do think David's right. I don't see how the sitting administration in any government will be able to withstand the onslaught of electoral displeasure if rates are 4.5%, 5%, and 6% going into November.
They are very likely going to come up with a strategy to try and win votes that will likely involve some sort of stimulatory process, would be my guess. And that stimulatory process may look something like more student loan forgiveness, more debt forgiveness. And here's the irony. The actions that the administration is likely to take to support themselves in the election cycle are likely going to further fuel inflation. And that's the biggest concern and worry I have, is that there's almost this inevitable set of behaviors that are coming down the pipe here over the next few months because of the inflation report that are actually going to make things worse, not better.
To your point, Biden just announced a new student loan forgiveness plan. Remember, the Supreme Court invalidated his last one, so now he's trying again, and it would potentially give loan forgiveness to something like 30 million borrowers. But look, I want to move beyond the political aspect of this and just talk about some more of these knock-on effects, because we talked about the impact on the consumer. There's also an impact on investors, there's an impact on the government, and there's an impact on the banks. Let's just deal with the banks for a second. Commercial real estate developers are hanging on by their fingernails right now. They basically borrowed huge amounts of money to buy commercial real estate when rates were really low, and they did so at high valuations. Now there's been a huge correction on that market, and they cannot pay back those loans, and they can't get refinanced. So what's happening? Well, they're working with the banks to restructure those loans to tack on the interest they can't pay now to the end of the loan, and then the bank will hope and pretend that they'll be able to get paid back one day. It's called extend and pretend. Well, the extend and pretend strategy could work if you believe that rate cuts are coming really soon, because you just need to hold on until the rate cuts are here, and then you can get refinanced at lower rates. But if rates are going to be higher longer, that strategy is not going to work, and you're going to see more and more real estate sponsors throwing in the towel, and banks are going to end up foreclosing on these properties, and you're going to see more and more fire sales. There's a really dramatic example just the other day in St. Louis. A building that was bought a few years ago for $200 million just fire saled at $2 million. I mean, 99% reduction. This is like .com crash. I assume the equity was completely wiped out. They sold it for $3.5 million, but it's also going to be a wipeout for the bank that made that loan originally, or bought that loan when it was repackaged into CMBS or whatever it was. I would expect that if rates stay higher longer, that's going to create tremendous stress on commercial real estate and therefore on the regional banking system that made all these loans to commercial real estate developers. So that's knock-on effect number one. Knock-on effect number two is the government's cost of borrowing. The 10-year rate's already risen to 4.5% now. And if rates stay higher longer, as more and more of the government debt rolls, it's going to end up getting refinanced at higher rates. And the need to refinance all of this government debt is going to continue to put pressure on the bond markets. And I think this is why Larry is fundamentally pretty bearish on rates going down, is the government's financing costs are so huge and they continue to grow. We're adding something like $1 trillion of new debt every 100 days. There have been some reports of this.
Yeah, 7.6 trillion is getting refinanced of old debt in the next 12 months. That 7.6 is sitting around 2%, and now it's going to get bumped up to close to 5%, which adds an incremental $210 billion a year of debt service expense just on the debt that's getting refinanced in the next 12 months. Not to mention the deficit, not to mention, et cetera, et cetera.
Right. So the government was extending and pretending as well. I mean, they were hoping that rates would go down fast enough that when all of this massive government debt rolls and needs to be refinanced, it would be done at lower rates. So the interest costs wouldn't swamp us. We're already, I think, at over $1 trillion now of annual interest expense for the federal government.
We are. Yeah. And it's going to rise to 1.6 trillion. So it's going to be 60% greater than our defense budget, just servicing the old debt.
We're basically in a classic debt spiral where we're borrowing. Our annual deficit we're at $2 trillion plus now. We're not paying back the principal on the debt. We're not even paying back the interest on the debt. We're borrowing money to pay off all the interest and then some on top of that. So that's a huge problem for the federal government. And then I think the last piece of this is investors. So what this chart shows is the Fed funds rate basically over the last 75 years. And you can see that it peaked in the early 1980s when Volcker decided to break the back of inflation by jacking up interest rates to 18%. And it was very painful. We had a pretty severe recession, and I think it was 81 or 82. But then the economy came roaring back by 83, and Reagan got elected in 84. In any event, that began a period of declining and low interest rates for investors, again, starting in the mid-80s, and it continued all the way through, I think, the post-GFC period, and then this COVID period where we had zero interest rates for a long period of time. And you can see the last spike we've had was when the Fed decided to jack up rates to 5% in response to inflation. So the fact that we've got this persistent sticky inflation suggests that this whole, you could call it really almost a 40-year period of declining and low interest rates may be over. And when interest rates are going down, it creates a huge tailwind to the stock market and the bond market because the discount rate is lower. So stocks and bonds are going to be more valuable. Well, if we're in a long-term environment that's more inflationary and rates have to stay higher longer, that's not great news for investors. It hurts the stock market, and it creates, in the private investing world, like VC and real estate, it creates a much higher hurdle rate. So it's harder for private investors to justify fundraising. So I think it's too early to say that this 40-year trend is over, but I think it could be. And the reason for that is just the huge pressure of government borrowing crowding out private investing, and this sort of ever-present need to keep issuing more and more debt at higher and higher rates to make it more attractive is going to create, I think, very bad conditions for investors.
So Chamath, let me ask you if you concur, given that today the NASDAQ is sitting at an all-time high, what's the disconnect in the market on why investors are buying equities, given that we're likely going to have persistent higher rates, and as a result, multiples should compress, particularly in growth stocks, and why the NASDAQ's kind of firing up?
I think it's important to look at what stocks are actually lifting the NASDAQ, just like what stocks are lifting the S&P 500. And we've seen this. There's a massive dispersion. There's like 7 or 8 companies that matter and 500 odd companies that don't matter much. And so the reason why things go up in an environment like that is, irrespective of the economy, money managers are paid to deploy money. And the global amount of total available equities to buy is shrinking. If you think about that, what that means is that the number of dollars is growing, right? Linearly, and in some years, it seems exponentially. So then a certain percentage of that finds its way into the equity markets. But when the equity markets continue to shrink and there's fewer and fewer things to buy, prices will still go up, irrespective of the underlying justification. So I think that the thing is, you can't look at these things as a sign per se. You know, if you look at, as a different example, commodities are up, broadly speaking, 30% since the beginning of the year. I think the reality is the following. Countries are feeling increasingly uncomfortable with the decisions that the United States are making. Whether that's its position to keep funding the war in Ukraine, whether that it's the continued instability in the Middle East, whether it's posturing with China, whatever it is. And so every country is now making a very different calculation about what they want to do. And I think how it gets reflected is that they are optimizing for their own economies. And what that yields is each of them trying to make as much money as they can in the short term. And as a country that is a net importer, we are going to feel the price of those decisions as inflation. And I think Sachs is right. Like, that's where we have to start figuring out how we rebalance these decisions from a foreign policy and economic perspective. Because if you don't change something here, all of these countries are basically going to be like, we're on our own. We're going to optimize for ourselves. These countries are basically voting in a way that says we are not being led in a way that we trust. And that unfortunately falls at the feet of the sitting president.
Look, I'm hopeful, as we all are, that work in the tech industry, that new tools and AI and other technologies would have a massive driver on productivity, which net could help even this out. That's the one last great hope. AI obviously viewed as being highly disruptive by non-technologists and deeply concerning, and particularly in DC.
What is that thing that Bill Gates says? Things are overestimated in the short term and deeply underestimated in the long term. That's what AI is.
That's right.
AI is a bunch of, no offense, probabilities and statistics today. So we should debunk this whole thing of like, there's some glowing brain somewhere that's capable of doing everything. Doesn't mean that we shouldn't underestimate it being capable of this in 5 or 10 years, which is probably the window in which we have some form of AGI. But today it's not that. And so the great leaps in productivity, Freeberg, that you're talking about are probably a 3 to 5 year phenomenon, not a 3 to 5 month. So what Sachs says is right, which is, how does the sitting administration votes today? It'll have to make a ton of promises. The problem is it can't really work its way into the economy fast enough come the November election. That's where I think they're in a really tough spot, which means that then, and I hate to be the bearer of bad news, but this is where you have a lot of these wag the dog kind of scenarios that come to mind, because then the only way to really galvanize a populace is to distract them.